My name is Anthony Fatsis, and welcome to the What the Finance podcast, where we interview finance, trading, and investing experts to help you understand current market trends and learn about the intricacies of new and existing assets. If you enjoy the podcast and to help with the YouTube algorithm, please like, comment, and subscribe. It really helps with the podcast. That means we can continue to get amazing guests. Thanks again, and I hope you enjoy. So hello, everyone, and welcome to another episode of the What the Finance podcast. And on today's episode, I'm happy to be talking with Alex Gurevich, founder and CEO of HonTe Advisors and author of the recently released book, The Trades of March 2020, A Shield Against Uncertainty, which we're very lucky to have Alex actually on the day of release. So thanks for giving your time. As you said, you're very busy. But just a quick intro into Alex. He's been involved in trading for 20 years, holding various roles on Wall Street that include launch of fixed income derivative trading franchises, as well as the running macro book at JP Morgan. So Alex, thanks again for joining me today. And just on to my first question, really, what was your influence for writing the book?
Well, first of all, thank you very much for having me over. By the influence, what do you think? What do you mean, like what other books influenced me, or what are the events that influenced me? Because it's a combination, of course, of a whole bunch of things.
Yeah, maybe both. Whatever, when were you like, I need to write a book now?
Yeah. Well, there was a funny moment actually. So during actually that month of March 2020, and that's really what my book is about. It's a day-by-day account of 1 month of my life, right? Or 1 month, which is 1 month of my life, but it's really 1 month of the life of this country, of the whole world, of this kind of descent and coping with the beginning of the pandemic crisis. As specifically applies to financial markets, but also with a lot of emphasis on how it affects your personal life and your psychological state of mind. That's what I really try to capture. And during that month, everything was there was so much happening. Everything was happening so fast that every trading day felt like a month. In fact, like the entire bear market happened like in a couple of weeks. And then 2 weeks later, there was no bear market. We all know that. And then I said, well, if you count every day as a month, then maybe it's a normal duration bear market, right?
Yeah.
And then like, this is the time was so stretched that I just kind of jokingly said it back then. Someone should write a book about this month. And then I was like, well, that should be me. I mean, I'm sure other people are writing books about pandemic, and there are some really good books about pandemic written. In fact, I'm like reading right now The Premonition by Michael Lewis. I'm reading it and loving it. And that actually made me think, when you talk about influences, that I kind of wanted to write more of like a big shot kind of book about the pandemic. But of course, with my own perspective, it's very different because everyone else, like I love Michael Lewis, that's why I brought him up, obviously, right? So he has good experience. He has some experience on financial markets. He's a really good writer. He's a journalist. He talks to people. He tells a story as he sees it. There are even more first-hand accounts, which, well, maybe his first book, Liar's Poker, was first-hand account. His other books are second-hand accounts. There are even first-hand accounts when people relate their memories, kind of tell what happened to them in life. And they could be very exciting to read those accounts, but our memories are biased. And our perceptions of situations are very skewed by our internal agenda. Not on purpose, it's just an internal agenda. So how do you deal with this? How do you let people really be a fly on the wall? And that is what I try to capture in this book by using time-stamped trading logs and transcripts. When you look at the chatter of actual trading chatter, it's so amazing because even reviewing it several months ago, did she really say this?
Yeah.
Did they really do this? And that was the moment, like when people say like, oh crap, there is no more money or whatever, the margins went up, or the dealers are not giving us any liquidity, or oh no, they're actually giving us liquidity despite the fact that they all have gone to home and working from their laptops for the first time in their life. What's going on? Like, will there be any funding? Will there be any balance sheet in 3 days, right? That I really wanted to give people a zeitgeist. It's like if you're in a Caribbean crisis, people wanted to have transcripts from the Oval Office, right?
Yeah, definitely. And I think one thing I've noticed, so you mentioned it there, like Michael Lewis, very good, but most of them are secondhand accounts. Whereas, and most people like yourself are very, very busy, don't usually have time to actually write a book. So it is very good to get sort of insights into someone like yourself who's running a successful fund, and just seeing the day by day chatter between everyone. And, for me, it sounded very calm, but I'm sure for you, it was pretty hectic at the time.
Well, I try to stay. The interesting thing is I always had this capacity to stay fairly calm in the middle of market volatility, even if I'm upset, even if I'm losing money, because no one likes losing money. I can assure you, even people who stay very calm are still in a worse mood on bad days.
Yeah, definitely. So we'll go on to your first book, because the subtitle was A Magic Sword of Necessity. And now your second book is A Shield Against Uncertainty. So there's a bit of a connection there. That was the subtitle for the second book. So why these titles? And I guess what importance do you give to a shield?
Well, first of all, I am a big fan of fantasy. So I read a lot of fantasy and science fiction. As an amateur, I'm trying to write it. That was actually my gateway into starting to write investment literature.
Oh, interesting. So there's another book coming out soon. Is that
Yes, I'm working on a lot of things. There's a lot of projects there. But investment writing came naturally for me because I've already practiced writing. And so in the very first book, I made this analogy of investment being as a battle. I know some people don't like violent analogies, but the practice is you can call it a battle, a competition, a challenge, a contest. Battle is just an archaic but very forceful metaphor. So and what I talked about in the first book is that you need to have good training and good equipment, and you need to have a reasonable amount of protection. So because no matter how well armed you are, if you're killed by a first arrow, that's not good, right? But then you may have your magic weapon that actually lets you win the battle. If I switch it for a second from battles to another area in which I do a lot of what I spend a lot of time in my life is strategic gaming, which my really gateway of finance was not as much mathematics as strategic gaming. And that's where I started to learn strategic resource management in particular. When you're gaming, you think of, okay, you want to build up your game, which is pretty well balanced, that you're not running out of any critical resources, like for example, if you have critical resources, food or whatever, right? But you also need to have some specific path to victory, something which will distinguish you, make you stronger than any opposition. And this is what I try to describe in my first book, A Magic Sword of Necessity, a principle that gives you enormous advantage. So my idea was, okay, I go through principles which basically protect your portfolio, make it solid, and then what it is, one thing that will make you break through. And that was a magic sword of necessity. And kind of the complement to that is, what if things go haywire? How do you survive? And hence, again, a shield against uncertainty. Those are the connected concepts. And it was in the first book, The Next Perfect Trade, was about delineating my strategic principles. Kind of qualitatively, this is how I select superior trades. Those are the parameters that if any trade satisfies a lot of those parameters, it's more likely to make money than lose money. And I always remind people, there is no certainties in markets, only certain likelihoods. When I say this is a great trade, it doesn't mean this trade will make money. This means that this trade is more likely to make money than lose money. Just a very good reminder to young traders. Very easy to get into this confidence area. It's all over. It broke out or it fell. Whatever, the chart, like resistance, supports, all smash through. This is going up. But all of those things really mean there is 51% chance that it goes up. And that's good enough for most situations because you have to keep repeating your experiment, right? This aside, I went through the principles that which have higher, a certain likelihood of being good trades. And then the second book gave me a chance to show, well, what if things are not as normal? How do we survive with these strategic principles? How do I apply them when commotion starts? Because on a regular trading day, well, yeah, you lose a little, you make a little. And honestly, this is not macro traders like my exist for things like COVID crisis or September 11th or global financial crisis. So when the markets perform fine and you're like in a normal environment, stock markets on average go up, the total community of hedge fund managers, especially managers like myself, global macro managers who bet on interest rates, currencies, commodities, would have hard time outperforming stock market on bull years. An individual trader can outperform, and I have outperformed in some bull years, but then on many bull years, I underperformed the stock market. That's not where you get your, that's not how you get your pedigree. That's not how you get your prices, right? What traders like myself do, they diversify performance when things get choppy. And that in itself actually does not mean that every macro trader gets every crisis right. What means that if you're a good global macro trader, at least there is no a priori assumption if stock market goes down, you go down. You may go down, you may go up. And on average, I tend to do well when there is crisis, when there is stock market sell-off. Basically what I'm saying is I not always tend to do better on up months, but I tend to do really bad on down months than stock market at least, right? But it does not mean, this is not really talking about performance. This is more like talking about the texture of how things trade. I just want to make sure I'm not making so much performance claims, and I'm trying to explain how it works. When things are in crisis, that creates opportunity. And you're not supposed to just sit on being long stock market and go up or down with it. That's not what macro traders are designed to do. That's not why people put them in their portfolio. So in years like last year, when stock markets are up 25%, who needs diversification, right?
Yeah.
But in 2020, in the beginning, you needed diversification because without it, you might have not been able to hold to your positions, depending on whether you have leverage and what kind of risk parameters you have. So this is when you try to shine, and you want to do better more often than not in those periods of time. And that's why it was so important for me to try to delineate how my strategic principles worked or did not work in such situation.
Yeah, definitely. I guess there's almost been a bad reputation for, global macro trading over the past 10, 15 years, because there's been quite a lot of stability. And, I think there's this whole argument against passive versus active. And I'm sure you've seen that as well. I don't know if you have an opinion on that sort of.
Well, there are a couple of things there. When people were talking to me before COVID crisis about underperformance of macro, I had several answers to that. One answer was, what underperformance? I'm doing fine.
Yeah.
And by I'm doing fine, it didn't mean at all that I'm doing fine every month. What it meant that I felt that I had my losses and my wins, which had nothing to do with being overall difficult environment for macro. People like to say this is a difficult environment for macro. I don't actually know what it means. It's a difficult environment for any trader who happens to be wrong.
Yeah.
And I'm well familiar with being wrong and facing difficult environments over my 20-year career. But I never felt like the market is difficult. I just felt like, well, the market did not what I wanted it to do. So we have to figure out, go on to the next way to make money, right? That's the first argument thing I was always saying, that the first thing I would say, it's not that markets are difficult, it's just it's not so easy to beat markets for anyone, and only a small percentage of people will consistently beat markets. So it's just a high bar to jump over, and people shouldn't be complaining if times are choppy in their portfolio, right? It's not market's fault. There is an objective concepts there, which is the benchmarking. Think about this: if you're a mutual fund manager, you benchmark to stock market. So you choose stocks. Say if you benchmark the S&P 500, you trade large caps. You choose your large caps. If you chose better than S&P, you're a winner. If you chose worse than S&P, you're a loser. But if you're a macro manager, you're really benchmarking to risk-free interest rate. You're supposed to underperform or outperform risk-free interest rates, because what happens is a lot of money of your money is in cash or short-term treasury securities, which serve as collateral to do various transactions, many of which are derivative transactions. but they all require collateral sitting in your portfolio. So if the rates are 5%, your portfolio will earn close to 5% as a base rate. And then if you outperform that base rate by 5%, you get 10%. So in a 5% environment, a 10% return for global macro funds was a fairly reasonable target. I don't know if they did it on average or not, but 8-10% is normal. But in a 0% environment, all of a sudden, if you outperform only by 3 to 5%, your return is 4%, and it looks mediocre, while nothing really changed in terms of your quality of trading. But also, when you don't think of benchmarking, you're starting, the stock market is up 25%, you were up 4%. All of a sudden, it looks kind of weak. That's why I started with this point that if you're benchmarking to risk-free interest rate, it's very hard to beat stock market consistently on the up years. And again, maybe there are people who do it. I'm just saying that it's a very, very high bar. The goal is really to make money on average and provide diversification on the down years.
Yeah, and I think I heard in one of your interviews you've done recently, I think it was Macro Talks, where you're talking about, all these stocks are actually trading against the US dollar. So it might not be the actual value of the company, it's actually the value of that specific stock against the US dollar. So, and that's, been going down. The US dollar has been going down for the last 100 years or whatever.
Yes. Oh, yeah. In terms of like continuously rising asset prices.
Yeah.
Yes. Yeah. If asset prices tend to go up, right? Yeah. The amount of dollars is increasing. Amount of stocks is increasing too, but not so much in the recent years. So the stock market is going up.
Yeah, exactly. And in the book, and you mentioned it there that you're a global macro trader, but I think in the book you had the whole title where it's an investment manager specializing in long horizon discretionary and then global macro trading. So I don't know if you can explain that a bit more. And you mentioned commodities, sort of, bonds, all those different things. Can you expand more on that and sort of how that strategy is different to other strategies?
Okay, so yeah, I'll try to unpack a little bit because hedge fund managers have a lot of strategic niches. Like there's a lot of people who do their own thing. And I think it's important to understand that when I don't tell I'm doing everything that is possible to do in financial markets. And correspondingly, no investor, I think, thinks that they should have all their money with me. Mm-hmm. You want to go diversification between strategies, one of which could be just directly being in stock market, another like owning a house, another. I'm not giving individual financial advice. It's totally what I'm not qualified to do, but I'm just saying that's how people tend to think. And then they go to this strategy and that strategy. So I am not, I'm just emphasizing this to make sure that I'm not trying to catch every opportunity in financial markets. I'm trying to catch opportunities that I'm qualified to catch. So what do I try to do? And there's a lot of adjectives, as you mentioned. Macro means primarily betting on directional moves in assets. That is, I'm not so much focusing on like short this versus long that or some kind of complicated and structured trades. Could be some elements of structure in my trade, but mostly I'm actually betting on the fact that this is going to go up. Like euro is going to go up, and euro is going to go down. Gold is going to go up, and gold is going to go down. Interest rates are going to be higher, or interest rates are going to be lower in this country or that country. And that's where global comes in, means that you do it all around the world. I'm not specifying on the region. It is harder to be an expert, of course, on the entire world. But the advantage of being what I do is that I'm not attached to doing any specific asset class. So for example, if I have no opinion on euro, I cannot really parse what's going on there. I don't have to have any position. There is no penalty for not having any positions for me in any specific region or country or asset class. So I can go around the world and look for the easiest opportunities, for the opportunities which seems to have best risk reward, which might compensate for the fact that I might not be an expert in deep expert on every single asset class. Because sometimes you don't need to be an expert, you can just need to have a good overview and see that based on like general principles, this is a good opportunity. And I say discretionary, which means that I make decisions as opposed to computer. And to be clear, I could use a lot of quantitative methods to aid in my decision making. We use portfolio optimization, we use trend signaling models and all that stuff, but the discretionary just means that in the end, I can decide what I want to do with my portfolio. And I'm emphasizing also long horizon, that it is my specialty to do trades which play over long periods of time, which was particularly interesting to see how it played in March 2020, where I was forced to trade very fast. And I had discussion about in my book what kind of changes in mentality or approach, or in which case it's not, in which sense it has changed, and which sense it has not changed when you go through crisis. Because I was emphasizing that the long horizon mentality is actually really good in navigating crisis, and that it could serve as a shield against uncertainty. But what I mean by long horizon mentality is that I have this theory that the highest probability of success concentrates somewhere on a time horizon of 2 to 5 years. This is where you can identify trades which have like 80% chance of being correct. When you do 1 day horizon, even the best traders can be correct like 52% of the time. Once in a long while, there is a layup and you can have 60% chance of being right. And you know, if you do daily trades and you right 51% of the time, if I mentioned earlier, you will accumulate performance. It is not my style. It's not what I enjoy doing. It's nothing wrong with that. Some people trade 20,000 times a day, right? If they're running some kind of computer program with even slimmer odds and they make great money. I'm not trying to do that. What I prefer is choose trades which have very high probability of making money or really good risk reward profile and hold them till they play out. That suits my psychological makeup, that suits my way of thinking, that suits my strategic advantage.
Yeah, and I think you mentioned a few trades in the book. Like one of them was AUD USD, and I think there was also, USD JPY. There was all these trades that you held for quite long periods of time, and they had these massive moves that, obviously, I'm sure the fund did very well off. But sort of in the book, and it's early in the book, you mentioned that in 2018 that you're just something clicked and you realized that the markets has actually changed compared to sort of what you thought they were beforehand. You had a realization, I think you said. So I don't know if you can expand on that more and maybe talk about what that realization was and sort of how it changed your trading thoughts.
Yeah, 2018. I started my book with talking about 2018 because it was a pivotal year in terms of how my portfolio was set up going into COVID. And that was also a difficult year for me. I had a very choppy performance in 2018, and I had a drawdown in the beginning of the year. I kind of clawed most of my way back out of it, but it was still a challenging year. But at the same time, in this type of challenge where the new ideas are getting forged, like forged by fire, whatever. I don't know what's the right expression, but tempered. Yes, it's a lot of things can be seen well retroactively, but it's hard to know often what market environment you are in ex ante. Like, okay, so there's a certain things happening, inflation is rising, unemployment market is good, Fed is raising rates, stock market is going up, everything chugging along. Where is the end to that? And when you are in that environment, there is a certain way to trade the market. There are certain interactions between asset classes that occur. Oh, if stocks go up, bonds go down, whatever. If rates go up, dollar goes stronger, all those like interactions. Then once in a while, once in a few years, we'll have a regime change. For better, for worse, or just a different regime. Regime changes are very hard for traders like myself because you really see them coming in advance. And things that have been working for you for 3 or 4 years are usually suddenly not working. And the flip side of being long horizon, you don't stop out at the first blip on the screen. You just kind of like, oh, okay, that's a blip. That tends to be my first reaction to anything that happens. That's a blip, right? And kind of stay the course. But then when things really change, then you have to survive a really severe drawdown and reposition and rethink your approach. And that is what happened in 2018. I started to realize from the price action in early 2018 that we're approaching the end of the hiking cycle and the easing will actually imminent, while all other people were still talking about hiking. I think this is a very important thing that happens with human thinking. Humans are very hard to not continue in their mind what is going on today and not projecting what's going on today into the future. I think I'm very good at it when it comes to markets. Sometimes, of course, I make mistakes, but I'm very good not to say like, oh, well, this is where I now, that's what's going to keep happening. Like I can step out of Zeitgeist and see, well, sooner or later, something else is going to have to happen. And this tendency is also, however, has a tension against the natural desire to follow trends, which is actually profitable. So on one hand, you want to follow trends because trend is your friend and you can ride them. On the other hand, you have to realize that certain things are just not going to be the same 2 weeks from now as they are today. This, for example, is very interesting in pandemic because pandemic goes in waves. And people make plans like, for example, oh, we are in the intelligent people can like say things like, oh, they would be in December and they would be saying there will be a big pandemic wave in January. So we're not going to plan anything for January, but by February, the wave will pass and we'll make plans. And it's hard to think that way because when things are in the middle of tension, in the middle of crisis, it seems like it's never going to end. That's what makes people like sell stocks at the bottom and things like that.
Yeah, definitely. And I think we've seen that over the past few days, talk of 3-4 interest rate hikes for the year. I think we've heard, and I'm not sure if you have an opinion on that.
I'm happy to talk about this. And it is interesting because this is the case that I've been wrong for a few months because I was actually not thinking that Fed would hike. And of course they have not yet, but it looks like they're very likely to. To me, that logically didn't make sense that they would hike this year. It still doesn't make any sense. I think it's a little bit of like collective delusion from my perspective, but it could be my delusion, right? You have to be a trader and you have to kind of say, this is my opinion, but this is what's happening and this is what I need to do trading wise. You need to not conflate those things. In my opinion, nothing really makes sense because I think inflation was a worry in 2020. I think inflation is not a worry at all today. I think inflation is something, it's a worry of the past. It's already gone. It's already not an issue. I feel very strongly that that's the bullet we have dodged, which was of serious concern in 2020. While other people are not worried, we're not worried about this in 2020, but worried about it now. I feel that I don't see why Fed would want to raise rates now when they have 14 trillion, whatever the size of the balance sheet is. Sorry, I don't remember, but why not unwind the balance sheet first? If you have a multi-trillion-dollar liability, why would you be raising rates on your own liability before you get rid of this liability? Because they have to pay interest on excess reserves, right? So why don't they just run off the balance sheet? That's plenty of tightening. Any amount of inflation could be suppressed by the amount of tightening coming from running off the Fed balance sheet. That would be much more tightening than this economy can take. So they really had no need to tighten the cycle at all. There was really no need to tighten in this decade. Rates could easily stay zero in this decade with any path of inflation just by manipulating the balance sheet. They could have chosen to do that. But somehow when supply chain constrictions caused the rise in headline inflation, they had a call to do something. But this is ridiculous, in my opinion, again, because what could the Fed possibly do about supply bottlenecks? Like you can raise rates all you want to, things will not get delivered faster. If anything, it'll make things harder because it'll be harder to get funding to improve infrastructure for companies to improve supplies. And then people like saying like, well, you have to reduce demand to reduce inflation, but that is really, to me, this is so backwards because if you ask yourself a real question like, what is bad about inflation? Why don't we like inflation running at 7%? Well, we don't like it because people have a hard time buying things, right? People are complaining that things are expensive. That's legitimate complaint. And inflation is running higher than wages. At least theoretically, you could kind of argue with the measurements, but now we're going to help people to make easier for them to buy things by taking money away from them. Because basically what the Fed is doing is, oh, you're trouble buying things. So how about this? We'll take money away from you. So it'll be even harder to buy things for you. And then maybe the prices will go down and eventually it'll be easier to buy things for you. To me, this is like a very backwards logic. It makes what I'm saying is, like, I don't know whether Fed should have been tightening earlier on or ending quantitative easing earlier on, whether they should have been concerned about inflation in the past. I see no reason for them to be concerned about it now, like really zero reason to be concerned about inflation now. This would be like the last thing about my worries, although I would be concerned about supply issues and quality of life of people receiving products, right, and services, not about headline level of inflation. And the changes just seems to be purely political and purely the thing of like your mind when zeitgeist affects your mind, I think. And I actually have a lot of respect for the Fed. I don't think they're stupid. I think they're doing their best, but even the best are affected by zeitgeist, or maybe like the political situation forces them to act in a certain ways. And then everybody in the market jumped on this bandwagon that rates are going up and up and up. And maybe they will, because again, it's not about what they should do, it's about what they will do. They say they will raise in March, they will raise rate in March. I can rage against the coming of the night all I want, all right?
Yeah.
But I think that it is very likely that they might get a few hikes and then it will roll over. Now I'm beginning like in 2018, starting to see the signs of shifts on the markets. And I'm seeing the sign of maybe now it's beginning to be likely, maybe we're closer to the late cycle now.
Yeah, and that would be quite scary. You know, we look at 2019 and what happened in the repo market, the shock. And as you said, the interest rates, they really struggled actually raising them above 2% in 2018, 2019. So, you know, you find it hard for them to be able to raise it to that same level with what we've seen over the past few years.
This time they might not make it to 1% because every time it's lower and lower how high they can raise rates. And there is a theory about this, as the larger the amount of global debt, because with every cycle we have more and more debt out there, then the more sensitive it becomes to raise on interest rates, right? If you raise 1% on a trillion, that's $10 billion more people have to pay. If it's 1% on 10 trillion, that's $100 billion people more have to pay. So that impact of incremental rate hike is greater and greater with every cycle. So like we got to 6.5% in year 2000, but we only got to 2.25% in 2018. So maybe this time we'll get to 1%, maybe to 0.75%, maybe 1.5%. I don't see signs that we're gonna go high. We will see.
Yeah, it'll be very interesting next few years. So we'll go back to the book because obviously, you know, the first week of March, there's a chapter all about that. And it was called The Victory Parade. And you mentioned how, you know, you're doing great. You had amazing returns. You know, the returns would be great for a whole year. When you look back, what do you think was the reasons that you did so well? Do you think you just set I think you mentioned that you were set very well over the past few years. You had some good positions. Were there any other reasons?
Well, the reason is that I was well positioned for crisis, and that's typically the case with my portfolio. So I was, as it happened, I was betting on rates to go to zero already, and I was already making money on this in 2019. And the theory was that, first of all, I felt that the cycle was rolling over in 2018, and secondly, even before 2018, I had a strong conviction next time anything happens, we're going to zero. I didn't know what it would be, but every 3 or 4 years, something happens. It's a global financial crisis, it's September 11th, it's some kind of like Russian debt crisis in 98, it's the European debt crisis in 2011, it's industrial recession of 2015. Every 3 years, something happens. If I go back, I can go back like 30, 40 years, and every 3 or 4 years, there is some kind of shock, unpredictable shock to the markets of significant portion. So I was sure next time something happens, we'll have to go to zero. So you just wait for it to happen and you make the money. So first of all, that was my position. Secondly, I felt that the cycle was rolling over. And thirdly, this was a bit fortunate. I was able to, there are certain trades that I discussed them in detail in my book. I don't want to go right now into technicals, but there are certain trades I do on a regular basis whenever opportunity presents that would benefit a lot in the event of a shock, some kind of black swan event. And it's not always available, but whenever possible, I do something like this. There are opportunities to do this stuff for free. I always do it. And hence, I made a lot of money in the 2001, and I made a lot of money in 2020. Not every time something happened, I did that well. But it is not like oh, this one time just I put the exact right position and exact right moment. It's my practice to take free options when I get them. If I have a free option for crisis protection, I try to be diligent about taking them, even if I don't anticipate any specific crisis. And it played out for me well in 2020, because it's not about betting on a slow recession. This is about betting on something exploding this month.
Yeah, and you mentioned how there was some sort of warning signs with the yields and all these different things. And like I found it very interesting. You mentioned strategy before, and you're a poker player, I think sometimes. And in the book, you sort of mentioned how if you bust out twice in the night, you then walk out. But if you're on a winning streak, you don't leave the table. You basically keep it going for as long as you can. And I think that would that define March quite well. You started off very well, so you just try to keep it going.
Definitely. Well, definitely it's an advantage. As a portfolio manager, you don't have like the luxury of just saying, okay, I quit. I just don't like I'm looking at the screens today. I don't like the market today. Bonds are down. I'm like looking at the screen right now. You know what? Nah, not working today. Don't put it in my P&L, right?
Yeah.
Nope, it's still going into my P&L, whether I like it or not, right? But in poker, you have that luxury. You can just say, you know what? This night is not going well. This guy sitting to my left is playing too strong and putting pressure on me. I'm not really feel the texture of the table. I'm gonna get out. Next time, easier pickings, right? Markets, and it's not so easy to do it in terms of portfolio, yet it's important to understand that thinking. Yes, if you're doing well, and this is what I really focused on this in my book, the psychological state as you trade. As you mentioned earlier, that I tend to be calm, but while probably my messages are calm and I'm not cursing loudly, you are still psychologically affected by pressures. And it's very important to kind of adapt to that. And instead of saying, no, nothing affects me, I'm just going to be cool as a cucumber no matter what, to realize that I'm a human being. How can I best trade with that fact in mind? And yes, when you're making money, it's so much, if you're an up year, it's so much easier to think clearly. As an experienced trader, you can think when you're down money too. You'll do your best. And as we discussed, I did a lot of my good thinking in 2018, which allowed me to reposition the portfolio. But it is hard time to press your advantage. You need to first stabilize yourself, stabilize your portfolio, start momentum in your favor, and then you can actually press your advantage. It's very hard to press advantage when things going against you. And it's hard to be very detached. One of the greatest things about poker, like how you can play really good poker when you're winning, is you're not attached to any specific hand. You know what? I don't feel good. I don't know what this person is doing. They're feeling a little too happy. Maybe I should just fold, right?
Yeah.
Right. The same thing in trading. I don't like this trade is going. I'm losing a bit of money on it, but something is just not the way I was thinking. Let's just let it go and move on to a better trade. It's much easier to make this type of wise decision when you have a good share of capital. And I feel like, yes, I was lucky in a way in 2020 that I started the year well. How I did afterwards had nothing to do with how I started the year, because by the time you were in the March, I mean, what positions you had before that are relevant. You just have entirely new portfolio, an entirely new set of decisions. But having started with a good cushion was good, because I was in a good positions to make good decisions. And when things don't go well, I was able to rationally manage them.
Yeah, definitely. And then, in the book, the second week and third week are titled "The Loss of Innocence and the Dark Days." So a lot more negative than the first week. And what really changed? Do you think was it just I've heard you mention liquidity in markets and how that liquidity shocks can really impact it. But do you think anything else changed over that week that caused that to happen?
Yes, well, there were two things happening simultaneously. One in the markets and one to me personally, because when up to maybe first week of March, we were taking seriously, but here living in California, there was still a sense it's not happening to us. And I kind of try to detail in my book like that step by step, how do you personally descend into pandemic fear too. But as the markets descend on it, kind of step-on-step process. First week of March, this is not happening to us. This is a pandemic, really unfortunate, catastrophic event that will have certain economic consequences, global slowdown. We're taking advantage of it. We're trading through this. We're taking profits. Everything is kind of running. Gradually, what started happening in March, first of all, it is happening to us. We are going into shutdown, right?
Yeah.
Our lives are in danger, or depending upon how personally you're fearful of it, you can think about your own life being in danger, or at least you have to navigate like safety and various compromises. And at the same time, I started to realize this is not just economic slowdown. Things are getting really funky here. And when things get funky, trades that make sense often go in the wrong direction. And fortunately for me, I already had the experience of 2007 when the global financial crisis started. Most people think of it as 2008, but the really awkward events started in 2007 when like the freeze outs and with things in subprime market and like the freezes and fixed income trading started to happen in August 2007, and I was blindsided by some of those actions back then. And I realized that things can go funky and things can go in the wrong direction. Going back to the movie Big Short, you could see how like some of the characters were complaining, like, these things are supposed to be moving in my favor at the beginning of crisis, but they're not. Why am I not making money? I have all the right positions. So you can be really caught in that situation of crisis, and that is, having navigated it in 2007, I was more prepared to navigate it in 2020.
Yeah, definitely. And I guess some of the instruments you trade, if they have less liquidity, then they might be affected a lot more than others. So there's that sort of intricacies involved as well, especially for what you're doing.
Yeah.
So the book ends, we'll skip the fourth week, sorry, but I found the book ending. You mentioned something called the Beanie Baby Theory, which I sort of found quite funny. And you can almost, you can replace that with any speculative bubble, NFT theory, maybe at the moment, crypto punk, whatever they call them these days. But I was wondering if you could maybe talk more about it, explain what the Beanie Baby Theory is and sort of why it's important for people to understand.
Yes, what I try to illustrate by this expression is that there is this common phrase like investors are flying to the safety of cash. But I was trying to emphasize the concept that I understood in 2020, that cash is not safe. And again, my experience was on March 2009, which when people sold everything, the stock market went down and everybody was on cash. Dollar was strong. Everybody was on cash. That was the biggest bubble. The biggest bubble of the great global financial crisis were not subprime mortgages, was not like mezzanine tranche, whatever, CDOs. It was the cash in March 2009, because everybody, when people sold bad assets, they also sold good assets and put money in cash. And then you're having an asset that Federal Reserve can print in unlimited quantities at zero cost. So how is it a safe asset if there is a monopolistic issuer of that asset and they can do it at no cost? And if you demand it, they'll give it to you. And that's what we learned in 2020. They gave us cash. You want cash, they'll give it to you. So, and then that's why I said, like, well, let's just rephrase all investment statements from portfolio managers by replacing the word cash by Beanie Babies. And the people saying Beanie Babies is king. I'm going to hold my portfolio safely in Beanie Babies for a while because there is crisis, there is a lot of uncertainty. I'll just stay in Beanie Babies for now and just wait. Maybe like at some point, there'll be a better chance to trade my Beanie Babies for real estate, gold, technology stocks. And you see how ridiculous it is, right? If you think on this mind. And you must delineate safety for individual who in a short term who needs to pay rent next month. If you have $1,500 rent due next month, yes, it is safe to have $1,500 and it's not less safe to have other things. But if you're a long-term investor over a long horizon, cash is proven to be very unsafe. In fact, it declines in value, as we mentioned earlier, right?
Yeah.
Continuously, while other assets tend to appreciate versus cash. So it's extremely unsafe asset in your portfolio over the long run. I'm not saying that it's an asset that can never be used. There are times that maybe cash is the best asset, but it's a conscious decision. You're investing in this risky asset because maybe you think that the supply of this asset is about to go down. Right. And then, but when the supply of this asset is high, it's like, what was the point of holding in cash in 2020 when they're printing trillions of dollars of it every day? And then how can you be surprised later when things just go crazy up in price? There is so much cash that people just stop taking it. Like people just say at some point, you know what? I'm not gonna take cash in exchange for GameStop. I'm no longer take cash in exchange for Ethereum, or I'm no longer going to take cash in exchange for Tesla stock. And you have those localized cash collapses. Then like some asset goes really up in price, but I see it as a localized cash collapse and just people stop taking cash in exchange for this asset.
And that's links to the liquidity issues that you talked about before, where a lot of these crises is that it's not asset bubbles or anything like that. It's to do with liquidity.
Well, it's the flip side, right? So you start with a shortage of cash, right? And then all of a sudden assets fall and people stop taking assets in exchange for cash, right? Then people hoard cash, assets fall. Then cash becomes so plentiful that eventually cash becomes useless. Useless not in terms, again, when I say useless, I'm emphasize it. In the daily life, people need to fulfill their needs, but it's a very different, but cash might become useless for portfolio manager when there's too much cash sloshing around.
Yeah, definitely. I think that's a very important point. So Alex, thanks again for joining the podcast to talk with me today. And just on to my last question, sort of, show the book, but what is one message maybe that you'd like readers and listeners to take away from your book and our interview?
I think what the really, especially for younger readers who are interested in financial markets, what I really want them not so much to take one single lesson, but to really know what it is like, to get a sense what it is like out there in the trenches, like what it is really to be a money manager. If they want to do this, like if you, for example, if you're a medical student, you go and watch the surgeries, right? You don't just read about it in books. So this is the closest I think I can get to people really watching things as they unfold. And so I wanted to show people what it is like so they have a good idea of what they're getting themselves into. Like all those, what it is like when you're in a situation at all. And at the same time, I did want to talk about a shield against uncertainty, about the things that in uncertain times you could clarify your mind and figure out, okay, well, there's tons of things we don't know. Why don't we stop betting on things we don't know and think of what do we know? And maybe we can find ways to bet on things that in this very uncertain environment, what are the anchor points of global financial structure that we can bet on? What will happen? Will the Fed add money if we're in crisis? Yes, they will, right? We do know that. When they're going to do it, how much? No, we don't know that. So let's not bet on that. Let's bet on the fact what will happen eventually.
Perfect. But yeah, Alex, thanks again for joining the podcast. So if you want to show your book again, and maybe if you want to, where would the best place for people to buy it, Amazon or any other book store?
Yes, it is available as of today. I'm not sure when this podcast goes out, but as we're recording it, it became available. The paper looks absolutely amazing. The graphics, the charts, it's like just done so well. And it's available to order on Amazon. I ask people to buy it and I ask people to leave reviews as soon as they can.
Yep, definitely. And I've read it and I'll definitely recommend anyone purchasing it. And, as a finance student, it's probably the realest I've seen of actually experience what it's like to be inside, these funds at that, at a time of crisis. So Alex, thanks again.
Thank you very much for having me on. It was a pleasure.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.